Vivek, hi, morning. As I look at my screen right now, the 10-year bond yields are down 17 bips. Would you say that in retrospect, as much as the market would want to blame Friday's fall on the RBI policy, the MPC chose to do the right thing?
Oh, absolutely. I mean, our call was for no change. And in fact, we recommended investors to stay bullish on bonds heading into policy. The reason is simple. I think there is a big difference between the way things pan out in 2013 and versus now. Market is simply applying a template of 2013, whereas the current situation is very different from 2013. India is already operating at a very high real rates. The sovereign bond yields and corporate bond yields are already operating much, much above repo rate, which effectively means that monetary conditions are much tighter than what your repo rate implies. And from that perspective, what RBI did, in our view, is absolutely right thing. Purely from a framework perspective, the whole flexible inflation targeting framework and the whole real rate framework that came into place stayed irrespective of the currency weakness, which in our view is the right thing.
Yeah, indeed. What is it, Vivek, though, that you're making of where the fisc situation may be headed? Because on Thursday, you also had the announcement of an excise duty cut on fuel. And, you know, while the finance minister over the weekend has reassured that he will not let the SCAD slip and there are measures being taken to ensure that, that's much of a market worry right now, whether or not they'll be able to, hold on to the fiscal deficit target, or would there be a big slippage there?
Right. No, I mean, on a fiscal, there is no doubt that there are worries. And I think this is one of the reasons why there is a term premium in the curve. And that's a worry that we have to live with. I mean, in every year around this time, in second half of the fiscal year, we do get worried about fiscal deficit, and this year is no different. Having said that, I mean, there are things which are not in our control. For example, oil prices, and which is one of the reasons why this year we are more worried on fiscal. Having said that, until now, whatever bites we have got from finance ministry suggests that they would like to stick with the fiscal deficit of 3.3%. For this year, and most importantly, the borrowing program that they announced at the end of September actually surprised on the positive side, which effectively means that it's just not the words which government is reiterating on fiscal, but at least on the borrowing plan, they are sticking with their view that fiscal will be 3.3%. So, I mean, I'm not saying that there are no risks. I think there are risks on that front, and market is worried about those risks. But for the time being, probably we have to take a step by step, and monetary policy giving a benefit of doubt to government on fiscal is and not overreacting to those fears on fiscal is also correct, because what they are seeing is how the inflation data is panning out.
Okay, Vivek, I know you may have covered this, in the earlier question that Aisha asked, but I still want to drill a bit more on this point. What about not moving on rates this time around and giving up the opportunity on protecting the currency? You've had Argentina try out rate tightening for the same reason, and Turkey also move higher on rates to, in a way, stem the fall. Do you think it's a missed opportunity from that standpoint? And are you worried at all about there being a currency rout in India? I mean, things going really far-fetched in one direction?
Okay, so I mean that's a fair. That's a very fair question, and one of the reasons why market was expecting a rate hike was because of markets' belief that that RBI will hike rates to stem the currency depreciation. I think so. There are 2 points that I would like to bring here, and I think this is important. I mean, the most probably similar market, not exactly similar, but one of the markets in Asia, which is a high yield market like India, is Indonesia. And even in Indonesia, what we are seeing is Bank of Indonesia hiking rates, and yet currency is depreciating there. So one of the things that I want to point out here is that just the assumption that another 25 basis point of a hike would have stemmed the currency weakness is not necessarily correct. Of course, it's a reject inferencing that we don't know, because something that didn't happen, we cannot say what would have happened. But from a framework perspective, India is already operating at a very high real rate. And the reason you hike rates to stem the weakness is you want to build in the real rate cushion. But as I mentioned earlier, because of the tighter liquidity conditions in the system and because of lower inflation, India's real rate cushion is already very high. So that's point number one. Point number two is, when we compare other emerging markets with India, there is a slight difference. For example, in case of Indonesia, in case of Malaysia, a lot of debt is in the hands of foreigners, and even Bank of Indonesia, for example, has a mandate of on rupiah, on currency, on stability of currency. Unlike Reserve Bank of India, which has a flexible inflation targeting mandate. And it's important to note that India's debt in hands of foreigners is much less as far as the positioning is concerned. So from that perspective, I'm not sure if it is fair enough to really compare other emerging markets with India. But on its own, given where the real rate cushion is and what's the framework that Reserve Bank of India is applying, I think it was a correct decision. Only time will tell what happens on the how the results of the decision pans out over coming weeks and months. But my view is that that over time, market will realize what Reserve Bank of India has done by changing its stance to calibrated tightening, effectively removing rate cuts on the table, and by not overreacting to the currency weakness is probably the right one.